Okay guys, so in this video we are going to discuss introduction under the standard of IAS 28, which is known as investment in associate. Okay, remember on the previous video guys, we discussed about IFRS 3 of business combination. We also do IFRS 10 of a consolidated financial statement. So in this video we are going to identify how are we going to see that this kind of combination need investment in association principle. Okay, so number one, they said equity method in terms of IAS 28 provide a guidance on accounting for investment in associate and joint venture using equity method. Okay, so when we apply investment in associate, obviously initially we need to recognize it using what? An equity method. Okay, so now let's discuss how do we identify this is an associate. Number one, you're going to see it by a word significant influence. Remember, in terms of IFRS 10, we discussed a word control. You have a power over another business, but in terms of IAS 28, you don't have a power, but you have a significant influence. Okay, so in terms of percentage, normally is in between 20 to 49 percentage. Associate on 20 to 49 percentage inside the group. Okay, however guys, it is possible that it can be less than 20%. How so? Less than 20%. Through agreement. So in other word, is bringing us back to significant influence term. So in other words, you need to check if they're saying that the company is owning 19%, but this company have a significant influence, which means that we are going to apply the principle of IAS 28. Very simple like that. Okay, significant influence, the standard defined concept significant to determine when the equity method should be applied. Okay, is supporting what I was saying. Equity accounting. Under equity method, investment is initially recognized at cost and adjusted for investors' share of post-acquisition change in investees' net assets. In other words, investment that we paid, for example, if we paid 500,000, we are going to recognize it under an asset, under non-current liability, under non-current assets, under non-current assets as an investment. But this amount is going to be adjusted. For example, if we paid dividends, we are going to subtract. If we paid a dividend by this company, which means that investment is going to be reduced. Okay, so this is what they're saying, that when they said and adjusted for investors' share of post-acquisition change in investees' net assets. Okay, shares is obviously is this one that I was talking about. Okay, identification of associate and joint venture criteria are provided to determine when the entity has joint control or significant influence over an investee. So IAS 28 provided that when the joint control or significant influence under investee, this is what I was saying. Okay, now let's talk about issue of intra-group, a transaction that happened inside the group. How do we treat them under IAS 28? How do we treat them? Okay, this is what we need to do. We must partially eliminate. When we said partially eliminate, for example, let's do example that we own 20%. Okay, so under associate we don't do consolidate. We don't consolidate. In other words, we don't combine a group our financial statement. Okay, so we're not allowed to combine financial statement. Only under IFRS 10 we can do those combination. Okay, we partially eliminate. Okay, when we say partially eliminate, we are saying that only percentage that we own, only percentage that we own. For example, this example as the similar one with the one that we did under what? Under IFRS 10. Number one, no borrow loan. No borrow. You are not allowed to borrow each other alone inside the group. Okay. Depreciation method must not change. Depreciation must stay constant. And another one, no change on cost price. No change on cost. Another one, issue of dividends as well. But guys, when it comes to associate, remember, let's say company A was using straight line and depreciation was 50, and company B was using diminishing balance and it gives them 60, which means that the difference is 10. This 10, guys, we don't eliminate in full. We only eliminate 20% of 10, which means that we are only going to eliminate 2 rand. This 2 rand is eliminated in terms of IAS 28. This one, because IFRS 10 eliminate in full, we are going to eliminate in full under IFRS 10 rand. So this is the difference between IAS 28 as well as IFRS 10. So this is the basic introduction, guys. We are going to do many question papers, like many tricks, so that you will understand all these standards. So I hope you enjoy, and please make sure that you subscribe to this channel, guys. This year our goal is to reach at least 10,000 subscribers. I'm gonna see you on the next one.